slightly raise individuals. When they start doing and talking like that, hey, we're gonna increase business taxes by 30%. Okay, so you're gonna get an extra 3%, but we're only gonna raise individual taxes by 2%. That's an extra 10%. Plus the employment taxes. And by the way, those employment taxes get paid by who? Anybody that's making less than 170,000 pays the vast majority of it. It phases out the old age disability and survivors insurance, which is 12.9%, phases out, or 12.4%, excuse me, phases out at about $170,000. And then you have the Medicare that carries on forever, and then they have a surcharge that adds on about 250,000. There's all sorts of fun stuff when you start diving into this. I'm going to show you how to avoid all that. All right. Then we look at the audit rates, and you start realizing that, wow, they really do just hammer the little folks. They do like to audit a high percentage of people making over 10 million or more. And if you're a really large company, like we start getting into here, over $1 billion, like, okay, you're probably going to get audited. You know who they don't audit? Look at these little partnerships and S corps. Like it's 0.1%. Who else is at 0.1%? If you make between 50,000 and 500,000, this is the sweet spot, 50K to 500K. You get audited once every 1,000 returns. I'm sure you knew that, right? Everybody's telling everybody the truth. No, they just make you scared. That's the numbers. And then I like looking at the partnership and S corps, because S corps rarely get audited. Corporations rarely get audited unless they're unless they're huge. You know who gets audited a lot? This is going to be fun for you guys. And I apologize. Let me see if I can put up my chat. I suck at doing chat at the same time. I'm going to see if you guys, who do you think gets audited the most? Which category of people? I'm going to give you some options. Individuals, sole proprietors, or corporations. What of those three get audited the most? Put it into chat. Individuals, sole proprietors, corporations. A lot of individuals, few sole props. Nobody's putting the corpse, so you guys are already getting it. Watch this. It's going to trip you guys out. You ready? If I could make the screen move, it'd be way cooler. Anticipation. Get this. Sole proprietors, you're making 100 grand. You're getting audited 1.6% of the time. That is a 1,600% increase over your S corp brethrens and most of the individuals. Yeah, the individual, if you were making 100,000, if you remember, it was 0.1. Huh. That sucks. But what I like to look at is how often they win. Hey, look, they win their audits a whopping 5 to 6% of the time, which means they lose their audits 94 to 95% of the time. Why on earth is your accountant telling you to be a sole proprietor? Like you could actually go pull this data. This is the last year. This is what is it? Table 17B of publication 55. The last year they published it, because guys like me were going all over the internet going, stop it! Don't be a sole proprietor. I don't want to say you're an idiot if you do it, but I am going to say your accountant should actually be factoring that in. How often do you get audited? Well, let's see. I just increased my audit rate by 1,600%. It's not that much. Right? I'm like, you got to be kidding me. Oh, and if I get audited, I lose. Why is that? Well, I'll give you an example. If I am a sole proprietor, and a partnership falls into this, if I'm a sole proprietor and I have a cell phone, I can only write off my business calls. I can't write off the full cell phone. I have to track it. How many people track it? Well, there you go, about 5%. Nobody tracks it, right? I had an accountant sitting in one of the live classes, and he stood up, and he goes, Toby, I just went through an audit on that. And they denied everything because the client didn't have records showing each call as being business or personal. And so they says he should have had a separate phone for his business and a phone for his individual. And I was like, no, you should just have a corporation, because a corporation can reimburse you, get this, 100% of this without having to jump through that hoop. That's why people like corporations, and that's why almost no successful people run as a sole proprietor. All right, remember we were talking about earning money. I said I would write it down later. Here's an individual, and here's a business. And I said I would write down the earn, tax, spend. Businesses earn, spend, and then they're taxed. We just want to spend a whole bunch of stuff that's deductible in our business. We also want to be careful over here. See, here's you. I'm very interested in what you're earning. I'm also very interested in what you're earning on investments over here, right? I like that business side. I like the real estate side because the spend, I may not even have had to spend it. Like I could have bought the property. That's my spend. I could have repairs. That's my spend. I get to write a whole bunch of stuff off. I can accelerate it. I can take it all now. I could have a huge deduction in year one. That's my spend. And what does it do to my taxable income? It squishes it. Sometimes it eliminates it. When I make money over here and I start earning, maybe I don't want to make income that hurts me. And let me explain. We have multiple types of income. If you go through this, by the way, guys, you're going to know more than 90% of the accountants out there. They've all learned this and forgotten it since they went to school. You have earned income, and earned income, you're taxed at your ordinary rate, which is 0 to 37%, your federal rate. You got state also. And you get Social Security. Which is 15.3%. 12.4% old age disability and survivors, 2.9% Medicare. If you work for an employer, they're paying half, you're paying half. If you work for yourself, you're paying the entirety. But the reason I bring it up there is because no other type of income has Social Security taxes on it, only your earned income. If I just know that, then it's going to tell me, wait a second, every time I go out and I earn $1, they're doing this to you. Whack. So, and I should say this, every time you earn a taxable dollar, especially as a W-2, the IRS is literally like the nun in Catholic school walking around with a ruler, and every time you get your paycheck, they're whacking you on the knuckles. I went to Catholic school, so I can relate to this. How many of you guys went to Catholic school? You remember the penguins with the rulers, and sometimes they threw erasers, sometimes they grab your ear. Right. You're getting a little whack. And I want you to think of the IRS as a penguin walking around, ready to give you a little whack. I don't want to be disrespectful to them. The mothers are great, wonderful people, but they do hit hard. So every time you're getting a paycheck, I just want you just to visualize somebody's just giving you a little whack, unless you can put it someplace where it's not going to be taxable or you can offset it. But the other types of income, there's only two. Portfolio income is one of them, and it's your investment types of income. It's going to have royalties, which are taxed at ordinary rates. No Social Security. Interest, ordinary rate. No Social Security unless you're a bank, unless that's what you're doing for a living. Dividends, dividends can get fun. If you're a U.S. company and you're getting dividends, let's see how many people know this. It's taxed at 0, 15, or 20%. It's taxed as long-term capital gains. And again, there's no Social Security. That's a qualified dividend. There's ordinary dividends. If you have like a master limited partnership, or you're working for an employer and they're paying you. Well, actually, in that particular case, it's going to be compensation. It's going to be up here. But if you're getting qualified dividends, even out of your closely held C Corp, you have your own company and you're paying 0, 15, or 20% depending on your income. Now, I'm just going to jump ahead and show you, oops, not that. I'm going to jump ahead and show you the rates. If you are married, filing jointly, and you have the long-term capital gains rates, you can make up to $94,000 and you're at the 0% category. 94 to